Hello, everyone! Before we can even begin to talk about filing a Canadian tax return, there's one fundamental question that has to be answered first. It's the question that really trumps all others. Are you a resident of Canada for tax purposes? Today, we're going to break down this absolute cornerstone concept. It's the very starting point for your entire relationship with the Canada Revenue Agency. Okay, so let's dive right in. The entire system of Canadian income tax, all of it, hinges on this one single determination: an individual's residency status. You see, before we can even ask how much tax someone owes, we first have to answer whether they owe tax to Canada at all, and on what slice of their income. It is, without a doubt, the cornerstone of the whole structure. So this is the essential question, isn't it? Resident or non-resident? Because the answer dramatically alters an individual's relationship with the CRA and the entire scope of their tax obligations. Think of it like a simple fork in the road, but the two paths lead to vastly different financial outcomes. And here's where you can really see the massive difference. If you're a resident of Canada, you are taxed on your income from all sources, no matter where in the world you earned it. Just think about that for a second. Income from your job in Toronto, rent you collect from a property over in London, and investment gains from a U.S. stock portfolio, it's all part of your Canadian tax base. A non-resident, on the other hand, is only taxed on specific types of income earned inside Canada. The financial stakes here are incredibly high. Now, you'd think that a term this critical, it's mentioned over 300 times in the Income Tax Act itself, would be clearly defined, right? Well, it's not. The Act actually gives us very little explanation. So to get the full picture, we have to look beyond the legislation. We have to turn to three core concepts that have been developed over time through the courts, the Act, and international treaties. So our first pillar is the one that's probably the most intuitive. We call it factual residency. And what's interesting is this isn't something Parliament wrote down in a statute. Nope, this is a principle that's been carefully built up by the courts over many decades. This definition is essentially asking a simple question: where is a person's life centered? This isn't about your citizenship or where you just happen to be on any given day. It's about looking at all the significant ties you have to a place. We're talking about things like where your spouse and children live, where you have your driver's license, your main bank account, or even just your gym membership. It's about putting all those pieces together to determine where you, for all intents and purposes, call home. This powerful language, this specific phrasing, comes from a landmark Supreme Court of Canada decision way back in 1946. It was the Thompson case, and it really set the standard. It tells us to look at where someone's life truly is, their social connections, their personal property, their daily routines. Believe it or not, this precedent has been the bedrock of our understanding for over 75 years. But what happens when your factual ties are a bit ambiguous? Or what if Parliament just wants to create a clear-cut black and white rule? Well, that brings us to our second pillar: deemed status. This is where a specific rule in the law or in an international treaty can actually override that factual reality we just talked about. And this is the crucial point. Even if you don't have those deep, centralizing ties to Canada, Parliament has created specific rules in the Income Tax Act that can deem you to be a resident anyway. It's basically a legal fiction, and it's designed to make sure certain individuals fall squarely within the Canadian tax net. The most common example here is the 183-day rule. It's a very simple, bright-line test. If you are physically present in Canada for 183 days or more in a calendar year, boom, the law deems you a resident for that year. It's a way to prevent people from enjoying the benefits of living here for a big chunk of the year without contributing tax. And similarly, the rules for government employees and their families make sure that those who are serving Canada abroad remain connected to our tax system. Okay, this brings us to a really common problem in our modern, globalized world. What happens when two different countries both consider you a resident under their own domestic laws? This is what we call dual residency. And let me tell you, without a solution, you could be on the hook for tax on your worldwide income in both countries. Not a good situation. So how do we solve this? The solution lies in tax treaties. These are international agreements that Canada signs with other countries specifically to prevent things like double taxation. And inside these treaties, there's a series of tiebreaker rules. They look at factors like where you have a permanent home, where your personal and economic ties are closer, and your citizenship. You can really think of it like a referee's call that makes the final decision on which country gets to tax you as a resident. It is absolutely vital to see the distinction here. Deemed residency is an inclusion rule from our own Canadian law. The Income Tax Act pulls you in. Deemed non-residency, on the other hand, is a relieving provision that comes from an international tax treaty. It can push you out of the Canadian tax system for treaty purposes, even if you are a factual or deemed resident under our own laws. So there we have it. We have our three pillars: the factual test from the courts and the two types of deemed status from legislation and from treaties. Let's just take a moment and bring them all together for a unified view of this whole framework. And this is how it all fits together, the complete legal framework. You see, you always start with the factual test. That comes from case law. If that's not conclusive, or if a specific rule kicks in, you then look to the legislation for deemed residency. And finally, if you're considered a resident of both Canada and a treaty country, the International Treaty Acts is the ultimate tiebreaker. It's a very clear hierarchy of rules. So just to recap, the foundation of factual residency is built on jurisprudence, that whole history of court decisions. Deemed residency, that's a creation of our federal legislation, specifically Section 250 of the Income Tax Act. And deemed non-residency as a product of international law, embedded in that network of tax treaties we have with other countries. So why does any of this matter? Well, understanding these distinctions is far from being just an academic exercise. For anyone living or working across borders, from new immigrants coming to Canada, for Canadians moving abroad, getting this determination right is probably the most critical step in your financial planning and tax compliance. Getting it wrong can have profound and very costly consequences. And this leaves us with a final and, I think, pretty provocative thought. Our core definition of residency, the one we've been talking about, comes from that Thompson case back in 1946. That was a time long before the internet, before digital nomads, before global remote work was even a dream. So how does a concept that's based on centralizing your ordinary mode of living apply in a world where our work and our lives are becoming more and more decentralized? That is a huge question, and it's one that tax authorities in the courts are grappling with right now. The answer will absolutely shape Canadian tax law for years to come.